Liquidity Term Premium, exploring yields and their impact on investments. Agenda Overview, Introduction to Liquidity Term Premium. We will start with an overview of what Liquidity Term Premium is and its significance. Influencing factors. Next, we'll discuss the various factors that influence Liquidity Term Premium. Market impact. We'll explore how Liquidity Term Premium impacts financial markets and investor behavior. Measurement techniques. We'll examine the methods used to measure Liquidity Term Premium accurately. And summary of findings. Finally, we'll summarize our findings and provide concluding remarks. What is Liquidity Term Premium? Definition of Liquidity Term Premium. Liquidity Term Premium is the extra yield that investors demand for holding longer-term securities. This premium compensates for increased risk associated with time. Investor compensation. Investors require compensation for the risks of liquidity over time. This reflects their preference for shorter-term investments. Time and liquidity relationship. The liquidity of financial assets decreases as the time horizon increases. Understanding this relationship is crucial for investors. Definition and importance. What is Liquidity Term Premium? Liquidity Term Premium reflects the additional yield investors require for holding longer-term assets. It compensates for potential market risks. Impact on investment decisions. Higher Liquidity Term Premium influences how investors allocate their resources. It shapes their risk assessment and investment strategies. Compensation for uncertainty. Investors demand higher premiums due to increased uncertainty in long-term asset holding. This impacts overall market dynamics. Key components of Liquidity Term Premium. Time horizon. The time horizon affects the liquidity premium significantly. Longer investments generally carry higher risk. Asset volatility. Asset volatility can influence the expected liquidity premium. Higher volatility often means higher risk. Market conditions. Market conditions play a vital role in determining liquidity premium. Economic factors can greatly affect returns. Factors influencing Liquidity Term Premium. Economic conditions impact. Economic conditions play a crucial role in determining Liquidity Term Premium. Changes in GDP and inflation influence investor expectations. Interest rate fluctuations. Interest rate changes directly impact the cost of borrowing and investment returns. High rates generally lower liquidity premiums. Investor sentiment. Investor sentiment affects market demand and liquidity. Positive sentiment typically increases liquidity premiums while negativity lowers it. Market liquidity. Market liquidity reflects how easily assets can be bought or sold. Higher liquidity usually results in lower liquidity premiums. Economic conditions. Influence of economic conditions. Economic factors like inflation and GDP growth significantly influence how investors perceive risk. Impact of stability. During stable economic periods, the liquidity term premium tends to decrease, reflecting lower risk. Role of uncertainty. In uncertain economic times, the liquidity term premium may increase as perceived risks rise. Market liquidity. Definition of market liquidity. Market liquidity refers to the ease with which assets can be traded without impacting their price significantly. Illiquid markets. In illiquid markets, it becomes challenging to buy or sell assets quickly, leading to potential price changes. Liquidity premium. Investors require a higher liquidity premium as compensation for the risks associated with liquid assets. Impact on financial markets. Liquidity Term Premium. It plays a crucial role in determining market dynamics and pricing strategies. Understanding this is essential for effective financial analysis. Influence on yield curves. The term premium directly impacts the shape of yield curves. This shapes investor expectations and future interest rates. Bond pricing effects. Bond prices are affected by changes in the liquidity premium. This relationship is vital for bond market investors. Guiding investor strategies. Investors adjust their strategies based on the liquidity premium. This helps in assessing risks and optimizing returns. Yield curves and bond pricing. Liquidity term premium. Liquidity term premium significantly influences the shape of yield curves. Steeper yield curve. A steeper yield curve indicates higher liquidity premiums for investors. Flatter yield curve. Conversely, a flatter yield curve suggests lower liquidity premiums. Bond pricing impact. Understanding yield curves aids investors in accurately pricing bonds. Investor behavior and strategies. Understanding liquidity term premium. Liquidity term premium reflects the extra return investors seek for holding less liquid assets. Grasping this concept is vital for informed investing. Influence on risk tolerance. The premium helps investors gauge their risk tolerance. It guides them in selecting investments that align with their comfort level. Formulating investment strategies. Understanding the premium allows for crafting tailored investment strategies. This alignment with expectations enhances decision making. Measuring liquidity term premium. Understanding term premium. The liquidity term premium reflects the additional yield for holding longer-term securities. It is critical for investors to consider. Importance of market data. Analyzing market data helps identify trends and shifts in liquidity. This analysis is essential for accurate premium measurement. Economic indicators role. Economic indicators provide insights into market expectations and economic health. They influence liquidity assessments and premium estimations. Modeling liquidity premium. Various financial models can estimate the liquidity term premium. Understanding these models enhances investment strategies. Models and approaches. Farmer-French model overview. The Farmer-French model expands on CAPM by increasing size and value factors in asset pricing. Liquidity-adjusted CAPM. This model incorporates liquidity risk into CAPM to better assess asset returns under varying market conditions. Quantifying liquidity term premium. Models help quantify the liquidity term premium, offering insights into asset pricing dynamics. Data sources and analysis. Importance of data. Financial market data is crucial for effective analysis and decision making. It helps measure the liquidity term premium. Types of data. Key data sources include bond yields and various economic indicators. These metrics guide financial analysis. Role of analysts. Analysts leverage this data to gain insights into market conditions and investor behavior. The analysis shapes investment strategies. Conclusion and insights. Importance of liquidity term premium. The liquidity term premium plays a crucial role in market behavior and investment strategies. Understanding it can enhance investment outcomes. Influence on investment decisions. This premium influences how investors make decisions regarding long-term assets. Awareness leads to better financial choices. Navigating market complexities. Understanding the liquidity term premium helps investors navigate the challenges of long-term investments effectively. Thank you.